Welcome to the Deep Dive. Really glad you could join us. If you like what we do here exploring these topics, maybe hit that subscribe button. It genuinely helps us out.
It does. And today we've got a really interesting one.
Yeah, we're diving into Archer Aviation tickers ACHR. We're working off an investment thesis and risk analysis from Stock Telescope. It's dated June 10th, 2025.
Right. And the goal really is to unpack what they're saying about Archer, understand the huge upside maybe, but also the very, very real risks.
Exactly. It's a pre-revenue company in this electric vertical takeoff and landing eVTOL space. We want to help you sort through it all.
And Stock Telescope, right off the bat, they frame it in a pretty stark way. They call it a high-risk, high-reward moonshot.
A moonshot. Okay.
Yeah, and they literally use the phrase lottery ticket investment. They say it's only for portfolios that can tolerate high risk, meaning you have to be prepared for the possibility of losing everything you put in.
Wow. Okay. So, like, a very clear warning. But
Despite that, yeah, the recommendation is actually speculative buy. They've put a 12 to 24-month price target on it, somewhere between $15 and $25.
okay, so let's get grounded. What's the picture right now, according to this analysis? The price they noted was around $11.26.
Yep, $11.26, which gives it a market cap of $6.18 billion.
$6 billion. And like we said, pre-revenue, that feels pretty substantial.
It is substantial. It's all about future expectation, right? Not current earnings. But the analysis does point to a positive, their cash, about $1.03 billion on hand.
Okay, that's a decent chunk of change. That gives them some runway.
It does. The report suggests it gets them through 2026, maybe a bit beyond. But
There's always a but. The burn rate, I assume. How fast are they spending that cash?
exactly. That's the flip side. The quarterly cash burn is significant, somewhere between $100 and $120 million.
Oof. So do the math. That $1 billion doesn't last forever at that rate.
No, it gives them roughly, 2.5 years, maybe a bit more at the current burn rate. And the market sees this risk. The report mentions the stock's volatility data of 3.13, which is really high.
Meaning it swings around a lot more than the general market.
Precisely. And there's also high short interest, around 15%. That tells you a fair number of investors are betting against the stock. Skepticism is definitely out there.
Okay, so high risk, high burn rate. But the potential upside comes from this huge market they're targeting.
That's the dream, yeah. The urban air mobility market. Projections are, well, massive. The analysis mentions forecasts, like Morgan Stanley's, I think, suggesting it could go from under $1 billion today to maybe $1 trillion by 2040.
$1 trillion. Okay, that's the kind of number that gets attention.
Absolutely. But the source, Stock Telescope, immediately throws some cold water on that. They flag it as a critical risk.
The market size itself is a risk. How so?
Because those huge projections depend entirely on a whole bunch of really optimistic assumptions clicking into place. Things like getting regulatory approval smoothly.
Which is a big one?
Huge. And also, widespread public acceptance. Will people feel safe? Will they use it? Then there's infrastructure, building all the landing pads, the vertiports. Costs need to come way down. And safety has to be, perfect.
Right. If any of those dominoes don't fall.
And the market could be, and this is the source's wording, dramatically smaller. So that $1 trillion figure is, very much a best case scenario.
Okay, that's a crucial dose of realism. But Archer has made progress, right?
Yeah.
The analysis mentions some strengths.
It does. Partnerships are key. They highlight Stellantis for manufacturing help, which is huge. United Airlines as a launch customer, that's major validation.
And defense, too.
Yep, and Dural for the defense angle, plus international moves like in the UAE. Operationally, they point to the manufacturing facility being ready. Over 400 test flights done with a good safety record, apparently.
And the FAA certification. That's the big hurdle.
They say Archer is about 3/4 through that process, still targeting late 2025 for approval from the FAA. Plus, there's this $6 billion plus order backlog mentioned, and the strategy to sell to both commercial airlines and the military.
So, definite signs of progress. But we keep coming back to the risks. The cash burn, the pre-revenue status.
It's the harsh reality. That burn rate showed up as a $109 million adjusted EBITDA loss in Q1. That's a big operating loss. And there's dilution risk, too. Lots of shares outstanding, over 549 million. So your slice of the pie could shrink.
But the number one risk, the one that Stock Telescope really hammers home.
Regulatory delays, absolutely the biggest one. The analysis specifically notes that a lot of industry experts are skeptical about that late 2025 FAA certification date.
Skeptical, meaning they think it'll take longer.
Yeah, the worry is testing bottlenecks, bureaucratic hurdles. The report suggests it could realistically slip to 2027. That's a significant delay, impacting cash burn, competition, everything.
And even if they get the green light from the FAA eventually, there's still the question of whether people will actually, use these things.
Exactly. Market adoption uncertainties. Public perception around safety is huge. Noise is another potential issue in cities. And cost, will it be affordable enough for regular people? Plus, the infrastructure, the vertiports, that's still way behind the aircraft development.
So it really paints two very different pictures. The bull case
Market leadership, they get certified on time. People love it. Rapid growth.
versus the bear case.
Delays, delays, delays. The market says, competitors beat them. And they just run out of money before they can really take off.
Which leads us back to Stock Telescope's final call.
Yep, speculative buy. But they circle right back to those warnings. Maximum 1 to 3% of your total portfolio. And only if you're genuinely okay with risk and have a long view, like 3 to 5 years minimum.
So it's for investors who understand the high chance of failure, but want a small piece of potentially transformative tech.
That's basically it. You need to be able to afford losing the entire investment. It's not for the faint of heart.
Definitely not. So it leaves us with a big question for you, the listener. When you look at something like eVTOL, this potentially massive market, but facing these huge regulatory and acceptance hurdles, how do you strike that balance between hope and skepticism? How much risk feels right when dealing with tech that could change everything or fizzle out?
Yeah, it's a tough one. Something to really think about.